Financial statements look intimidating. Rows of numbers, unfamiliar line items, terms like accrued liabilities and amortization that nobody explains in school, all formatted in a way that seems designed specifically to be confusing. Here is the reframe that changes everything. Financial statements are not written in a foreign language that requires years of study to decode. They follow a small number of consistent, learnable structures. 3 core statements, each answering one specific, fundamentally simple question. And once you understand that structure for one company, you understand it for every company, in every industry, in every country that follows similar accounting standards, because the structure itself does not change. A company's income statement always answers the same question. Did this company make or lose money over a specific period of time? Its balance sheet always answers a different question. What does this company actually own and owe at one specific moment in time? Its cash flow statement always answers a third, distinct question. Where did the actual cash physically come from and go during that same period? These 3 questions, and the 3 statements that answer them, are the entire foundation. Everything else, every specific line item, every ratio, every more advanced concept in financial analysis, is simply a more detailed elaboration on one of these 3 core questions. This video walks through each of the 3 statements using a single, consistent, fictional example company. The one specific number that appears at the bottom of 2 completely different statements, and what it means when those 2 numbers tell conflicting stories, and the handful of simple ratios that connect everything together into a genuinely usable skill. The income statement, sometimes called the statement of operations or the profit and loss statement, answers one specific question. Over a defined period of time, typically a quarter or a full year, did the company make or lose money? And through what specific path did it arrive at that final answer? It is read, conventionally, from top to bottom, with each line representing a further refinement of the figure above it. Building Maple Company's income statement, line by line, using illustrative round numbers for a single fiscal year. Revenue, sometimes called sales or top line, $10 million. This is the total amount of money the company generated from selling its products or services, before subtracting any costs whatsoever. It is called the top line specifically because of its position at the top of this statement. Cost of goods sold, $4 million. This represents the direct costs specifically required to produce the goods or services that generated the revenue above. Materials, direct labor, and similarly direct production costs. Gross profit, $6 million. Revenue minus cost of goods sold, $10 million minus $4 million. This represents the profit remaining after covering only the direct costs of production, before any other business expenses are considered. Operating expenses, $3,500,000. This category covers the broader costs of running the business beyond direct production. Salaries for administrative staff, marketing and advertising spending, rent on office or facility space, and similar ongoing operational costs. Operating income, sometimes called EBIT, for earnings before interest and taxes, $2,500,000. Gross profit minus operating expenses, $6 million minus $3,500,000. This represents the profit generated specifically from the company's core business operations, before accounting for the separate effects of debt financing costs or tax obligations. Interest expense, $500,000. This represents the cost of interest payments on any debt the company has taken on, a distinct non-operational expense reflecting how the business has chosen to finance itself. Pre-tax income, $2 million. Operating income, minus interest expense, $2,500,000 minus $500,000. Tax expense, $500,000, using an illustrative combined tax rate of 25% applied to pre-tax income. Net income, sometimes called the bottom line, $1,500,000, pre-tax income minus tax expense, $2 million minus $500,000. This is the final, fully refined profit figure. What remains after every single cost, expense, interest payment, and tax obligation has been subtracted from total revenue. Why this top-to-bottom structure matters for interpretation, not just calculation. Reading an income statement well means understanding not just the final net income figure, but where, specifically, along this chain of subtractions, the company's profitability is strongest or weakest. A company with a strong gross profit margin but weak operating income may have a fundamentally sound core product but excessive administrative or marketing spending. A company with strong operating income but weak net income, after a meaningful interest expense deduction, may have a sound business burdened by a heavy debt load. A distinction the bottom line number alone does not reveal. Your action step. For any company's income statement, you examine, calculate the gross margin, gross profit divided by revenue, and the net margin, net income divided by revenue, separately, and compare the two. A wide gap between them tells you that a meaningful portion of the company's revenue is being consumed somewhere between the production line and the final bottom line. The balance sheet answers a fundamentally different kind of question from the income statement. Rather than describing a period of activity, like a quarter or a year, it describes a single specific moment in time, typically the last day of a reporting period, and answers, what does the company actually own? What does it actually owe? And what is left over for its owners after subtracting the second figure from the first? The fundamental equation behind every balance sheet, without exception. Assets equals liabilities plus shareholders' equity. This equation is not a coincidence or an approximation. It is true by definition and by accounting structure every single time for every single company, because shareholders' equity is specifically defined as whatever remains after subtracting what is owed, liabilities, from what is owned, assets. This is precisely why the document is called a balance sheet. Both sides of this equation must always balance exactly. Building Maple Company's balance sheet, using illustrative round numbers as of a specific date. Assets. Everything the company owns or is owed. Cash and cash equivalents. $1 million. Accounts receivable. Money owed to the company by its customers for sales already made, but not yet paid for. $1,500,000. Inventory. Goods produced but not yet sold. $2 million. Property, plant, and equipment. Buildings, machinery, and similar long-term physical assets. $8 million. Total assets. $12,500,000. Liabilities. Everything the company owes to others. Accounts payable. Money the company owes to its own suppliers for goods or services already received, but not yet paid for. $1 million. Short-term debt. Borrowed money due within the next year. $500,000. Long-term debt. Borrowed money due beyond the next year. $5 million. Total liabilities. $6,500,000. Shareholders' equity. Total assets minus total liabilities. $12,500,000 minus $6,500,000. Shareholders' equity. $6 million. Why distinguishing current versus long-term items matters specifically. Notice that several items above are explicitly distinguished as short-term or current versus long-term. short-term debt due within a year versus long-term debt due beyond a year. This distinction matters enormously for assessing a company's near-term financial health, because it specifically isolates obligations that must genuinely be addressed soon, within the coming year, from those that can be managed over a much longer time horizon, a distinction explored further through a specific ratio in Segment 4. Why a balance sheet, unlike an income statement, is a single-moment snapshot rather than a period-long story. This is the key conceptual difference between the two statements covered so far. The income statement tells a story about activity across an entire period. Did the company make money over this particular quarter or year? While the balance sheet is a photograph of one single, specific moment. What did the company own and owe on this one particular date? Meaning, a company's balance sheet can, and routinely does, look meaningfully different from one reporting date to the next, even within the same single fiscal year, as assets and liabilities shift continuously with ongoing business activity. Your action step. For any company's balance sheet you examine, identify specifically how much of its total assets are tied up in cash, the most flexible, immediately usable asset, versus how much is tied up in less liquid assets like inventory or long-term property. A company with the large majority of its assets locked into illiquid forms has less immediate financial flexibility than the same total asset figure might otherwise suggest. The cash flow statement answers a question distinct from both of the previous statements, not whether the company was profitable on paper, the income statement's question, and not what it owns and owes at one moment, the balance sheet's question, but specifically where actual, physical cash came from and where it actually went during a given period. The three sections every cash flow statement is organized into: cash flow from operating activities, cash generated or consumed by the core, day-to-day business operations, cash flow from investing activities, cash spent on or received from longer-term investments, such as purchasing new equipment, acquiring another business, or selling off existing long-term assets. Cash flow from financing activities, cash received from or paid out through financing-related activities, such as issuing new debt, repaying existing debt, issuing new shares, or paying dividends to shareholders. Here is the vault from the opening: net income versus operating cash flow. Why a company can report positive net income on its income statement while simultaneously reporting negative or weak cash flow from operations, and why this gap is one of the single most important things to check. The income statement, under standard accrual accounting practices, recognizes revenue when a sale is made, not necessarily when the cash for that sale is actually received, meaning a company can report a sale and the corresponding profit the moment it ships a product or completes a service, even if the customer has not yet actually paid for it, creating the accounts receivable line item covered in Segment 2. Similarly, certain non-cash expenses, such as depreciation, the gradual recognition of a long-term asset's cost over its useful life, and amortization, the equivalent concept applied to certain intangible assets, reduce reported net income on the income statement without representing any actual cash leaving the company during that specific period. A concrete illustration using Maple Company. Maple Company reported $1,500,000 in net income on its income statement for the year, covered fully in Segment 1. Suppose, however, that during this same year, Maple Company's accounts receivable grew substantially, as it extended more generous payment terms to a major new customer. And suppose it also recorded $800,000 in depreciation expense on its income statement, a non-cash expense, added back when calculating actual cash flow. After adjusting net income for these and similar factors, Maple Company's actual cash flow from operating activities for the year comes to $1 million, a real positive number, but notably different from the $1,500,000 net income figure reported above it, illustrating precisely how these two numbers, both legitimate and both important, can tell meaningfully different stories about the same underlying period. Why this distinction matters so significantly in more extreme cases. In genuinely concerning scenarios, distinct from Maple Company's relatively modest, explainable gap above, a company can report strong, positive net income for several consecutive periods, while simultaneously experiencing genuinely negative operating cash flow, often because revenue is being recognized on sales to customers who are taking increasingly long to actually pay, or because of other accrual accounting timing differences building up over multiple periods. This specific combination, positive reported profit alongside negative or sharply declining actual cash generation, has historically been one of the most reliable advance warning indicators that a company may be heading toward genuine financial distress well before that distress becomes visible through the income statement or balance sheet alone, because a company can survive being unprofitable on paper for a meaningful period if it is still generating real cash, but it cannot survive running out of actual cash regardless of how profitable its income statement claims it to be. Your action step for any company you examine: explicitly compare its net income to its cash flow from operating activities over the same period. And if a significant, sustained gap exists between the two, particularly if operating cash flow is meaningfully weaker than reported net income across multiple consecutive periods, treat that gap as a specific signal warranting further investigation into why, rather than relying on the net income figure alone. Here are 4 simple, widely used ratios that connect the 3 statements together into genuinely usable insight, using Maple Company's figures established in the prior segments, followed by exactly where a Canadian investor can access these actual documents for real, publicly traded companies. Ratio 1, Current Ratio, Liquidity, current assets divided by current liabilities. Using illustrative current asset figures for Maple Company of $4,500,000, cash, receivables, and inventory combined, all assets the company could reasonably expect to convert to cash within a year, against current liabilities of $1,500,000. Accounts payable plus short-term debt, both due within a year. The current ratio is $4,500,000 divided by $1,500,000, which equals 3.0. A current ratio above 1.0 generally indicates a company has sufficient near-term liquid assets to cover its near-term obligations. A ratio meaningfully below 1.0 can signal potential near-term liquidity stress. Ratio 2. Debt to equity. Leverage. Total liabilities divided by shareholders' equity. Using Maple Company's figures from Segment 2, $6,500,000 in total liabilities divided by $6 million in shareholders' equity equals approximately 1.08. Meaning the company has slightly more in total obligations than it has in owner-funded equity, a moderate, though not extreme, level of leverage that should be compared against typical levels for companies within the same specific industry, since capital-intensive industries, such as utilities or telecommunications, routinely operate with meaningfully higher debt-to-equity ratios than other industries as a normal structural feature of their business model. Ratio 3. Net profit margin. Profitability. Net income divided by revenue. Using Maple Company's figures from Segment 1, $1,500,000 in net income divided by $10 million in revenue equals 15%, meaning the company retains 15 cents of profit for every dollar of sales generated, after accounting for every cost along the way. Ratio 4. Price-to-earnings ratio. Valuation for publicly traded companies specifically. Share price divided by earnings per share. This specific ratio requires one additional piece of information beyond the three core statements: the company's current publicly traded share price. If Maple Company were a publicly traded company with, hypothetically, 1 million total shares outstanding, its earnings per share would be its $1,500,000 net income divided by 1 million shares, equaling $1.50 per share. If Maple Company's shares were trading at a hypothetical $22.50, its P/E ratio would be 22.50 divided by 1.50, equaling 15, meaning investors are currently willing to pay 15 times the company's most recent annual earnings for one share, a ratio frequently used to compare valuation across different companies, though one that requires careful comparison against genuinely similar companies and industries to be meaningful, since normal P/E ratios vary considerably by industry and growth expectations. Where Canadian investors can actually access these documents for real public companies, Canadian publicly traded companies are legally required to file their financial statements with securities regulators, and these filings are made publicly and freely available through SEDAR+, the System for Electronic Document Analysis and Retrieval Plus, Canada's official platform for public company disclosure documents, where any investor can search for a specific company and access its actual audited financial statements, management discussion and analysis, and other required regulatory filings at no cost. For companies listed on U.S. exchanges, the equivalent platform is the SEC's EDGAR system. Your action step: choose one real, publicly traded company you are genuinely curious about. Search for it on SEDAR+, or EDGAR if U.S. listed. Locate its most recent annual financial statements and attempt to identify its revenue, net income, total assets, total liabilities, and operating cash flow using the exact same structure and line items covered in this video. Let's come back to where we started. Financial statements are not a foreign language. They are a structure. Three core statements, each answering one specific learnable question that, once understood for a single company, applies identically to every other company you will ever examine. Here is Maple Company's complete assembled picture, using everything covered across this video. The income statement tells us the company generated $10 million in revenue and converted that into $1,500,000 in net income, a healthy 15% net margin. The balance sheet tells us the company owns $12,500,000 in total assets, owes $6,500,000, and has $6 million in shareholders' equity, with a current ratio of 3.0 indicating solid near-term liquidity, and a debt-to-equity ratio of approximately 1.08, a moderate level of leverage worth comparing against its specific industry. And the cash flow statement tells us that despite that healthy $1,500,000 net income figure, the company's actual operating cash flow for the same period was a somewhat lower, but still genuinely positive, $1 million, a real, important nuance that the net income figure alone would never have revealed. No single one of these three statements, viewed in isolation, would have given you this complete picture. The income statement alone would have made the company look more cash-generative than it actually was. The balance sheet alone would have told you nothing about whether the company was actually profitable during the period being examined. Only by reading all three together, and specifically checking for the kind of profit versus cash gap covered in Segment 3, do you arrive at a genuinely complete, accurate financial picture. This is a literacy skill, not a complete investment strategy on its own. but it is one of the most genuinely useful, permanently applicable skills available to any Canadian who wants to understand, with real confidence, what is actually happening inside any company whose name appears in the news, in your portfolio, or in your own curiosity.